Hi friends, today's topic is about methods for providing depreciation. Regarding depreciation, I made another video, that is depreciation accounting part 1. First you have to watch that video, then only we'll understand this present video. Because in that video, I explained the meaning of depreciation, then characteristics of depreciation, need and the causes of depreciation. So that video link I'm giving in description box. First you watch that video. Now, methods for providing depreciation is the present topic, and we have total 10 methods to provide depreciation on any fixed asset. By seeing this number, immediately we'll get one doubt. That is, why this many methods are required? Depreciation, only one amount now. So to calculate that, any one method is enough. Why this many methods are required? The reason is, a firm uses different types of assets. Fixed assets are so many. Suppose firm uses a machine, firm uses furniture and vehicles, computers, livestock, sports material, buildings, leasehold properties. The nature of all these assets is not same. Since different types of assets we have, we need different methods of providing depreciation. Okay? Now, in present video, total 10 methods I cannot cover. Our present video is limited to this first method, straight line method. So first method is called straight line method. This method is also known as original cost method or fixed installment method or equal installment method. Then what is the meaning of this method and what are the advantages and disadvantages of this method? On which assets we have to apply this method? All these points I am going to explain with the help of one problem. So, problem number 1. See the question. Sri Sai and company purchased a machine for 2,50,000 on 1st April 2009. On 1st April 2009, they purchased one asset for 2,50,000 rupees. Estimated life of the machine is 10 years. So, estimated life is 10 years. The scrap value at the end of its life is 50,000 rupees. Scrap value is 50,000 rupees. Calculate the annual depreciation. What he is asking? Annual depreciation and rate of depreciation. Second question is rate of depreciation. Assuming that accounts are closed on 31st March every year, then show the missionary account for first 3 years. Another question is missionary account for 3 years he is asking under fixed installment method. This is the question. Okay. See, let us understand this problem. A firm purchased one machine on 1st April 2009 for 2,50,000 rupees. So machine comes under fixed asset. So we have to provide depreciation on that, and cost of the asset is 2,50,000 rupees. And that machine has a temporary life now. So for 10 years we can use this asset. Life of the asset is 10 years. We are estimating like that. And scrap value of this asset is 50,000 rupees. What is meant by scrap value? When the asset is totally damaged, then when we sell the asset on scrap basis, the amount which we are going to fetch. Then with this information, we have to calculate annual depreciation under fixed installment method, straight line method, then rate of depreciation, and we have to show the asset account for first 3 years. This is the question. Okay, let us solve this problem. First, annual depreciation. Every year, since we are using that asset value reduces, and how much will be that reduced amount? How much will be the depreciation? We have to calculate now. Under fixed installment method, he is asking. Then, solution. See, under fixed installment method, to calculate annual depreciation, there is a formula. That is cost minus scrap value divided by estimated life of the asset. In present problem, cost is 2,50,000 rupees minus scrap value is 50,000 rupees and estimated life is 10 years. Remember one point, there is no rule that compulsory he should give scrap value in the question. Sometimes scrap value may be a negligible amount. Then he may not give the scrap value amount. Then what we should do? Since the scrap value is not given, without taking the scrap value only, we have to calculate the depreciation. Okay? Now, 2,50,000 minus 50,000 is equal to 2 lakh. 2 lakh divided by 10 is equal to 20,000 rupees. So, annual depreciation is 20,000 rupees. Now, second question is what? He is asking us to calculate rate of depreciation. Under fixed installment method, to calculate rate of depreciation, there is a formula. That is annual depreciation divided by cost into 100. Why with 100 we have to multiply? Because he is asking us to calculate the rate of depreciation. Rate means percentage, no? That is why. Annual depreciation is already calculated here. 20,000 rupees divided by cost of the asset is 2,50,000 into 100. 4 into 2, 8. And remember, for your answer, you have to put percentage symbol. Because we are calculating rate, no? Rate means percentage, no? So, depreciation percentage under fixed installment method is 8%. Okay? Now, third question is what? He is asking us to prepare missionary account. Okay? Let us prepare the missionary account for 3 years. Now, how to prepare missionary account? Let us see. See, this is account format. Account contains two sides, debit side, credit side. Debit side we have 3 columns, date, particulars, amount. Credit side also same. Okay? Now, first what happened? On 1st April 2009, firm purchased a machine for 2,50,000 rupees. This is your first transaction. Okay? Then what is the journal entry for this? Let us see. This is firm. Whenever you are preparing accounts, always you have to think from firm's point of view. So assume that you are working under this firm. Now, this firm has purchased one machinery from a supplier. Okay? Then what is coming to us? Machinery. Since supplier name is not given, this is cash purchase. Means in return what we pay to them? Cash. Machinery is coming and cash is going. Now in any business transaction, minimum 2 accounts will be there. Those 2 accounts we have to identify. Think from firm's point of view. What is coming to us? Missionary. So missionary account is one account. Then what is going from us? Cash. Cash account is another account. Now we know that accounts are of 3 types: personal accounts, real accounts, nominal accounts. Now identify the type of this account. Missionary account. Missionary is an asset, no? All assets come under real account. So missionary account is a real account. Cash is also same. Cash is an asset. So cash also comes under real account. Then final step is apply the real account double entry principles. What is real account rule? Debit what comes in, credit what goes out. So think from firm's point of view, what is coming to us? Missionary. Therefore, debit missionary account. Even cash account is also real account. So same rule is applicable. Debit what comes in, credit what goes out. And cash is going from the firm now. So we should credit cash account. Then what is the final entry? Missionary account at R2, cash account. Okay. Now our present account name is missionary account. Missionary account is debited. Therefore, this entry in debit side of missionary account we should post. So debit side, with what we have to start? With 2. What to write? Other account name. In journal entry, what is the other account? Cash account. So write down cash account. When we bought this asset? On 1st April 2009. For how much? 2,50,000 rupees. Assume that instead of paying cash, we issued a check. Then what to write here? To bank account. So you can write to cash account or to bank account. Both are correct. Right. Then from 1st April 2009 to 31st March 2010. For 1 year we use this asset. Recollect the question? He has given that firm is following financial year. Financial year starts with the 1st April and ends with 31st March. On 1st April 2009, they bought this asset. So from that date to 31st March, then what will be the year? 2010, no? So from this date to this date, 12 months gap is there. This is your first year. Now second year will be 1/4/10 to 31st March 11. Then third year is 1/4/11 to 31st March 12. In question he is asking us to prepare missionary account for 3 years. 3 years means from 1st April 2009 to 31st March 2012. We have to show this missionary account. Now first year last date is 31st March 2010. Okay. On that day we have to provide depreciation on this asset. Okay. What is the entry for that? See. Depreciation is a loss. Losses come under nominal account. What is nominal account principle? Debit all expenses and losses, credit all incomes and gains. Since depreciation is a loss, it should be debited. So in journal entry, depreciation account comes in debit side. Then credit side, what to write? We are providing depreciation on machinery. That much of machinery value is reduced. So machinery comes under real account now. Real account rule is debit what comes in, credit what goes out. Physically machinery is not going anywhere. It is with us only. But since value is reduced, it gives the meaning that that much of machine is going from us. Therefore, credit side we should write missionary account. This is the entry for depreciation. Depreciation account at R2 asset account. Now, missionary account we are preparing. In journal entry, missionary account is credited now. Therefore, this entry in credit side we have to post. So, credit side with what we have to start? With by. What to write? Other account name. What is the other account? Depreciation account. Write down that. And how much amount we have to write? Recollect the previous calculation. Annual depreciation is 20,000 rupees now. That amount we should take here. Now, we have to balance this account. Observe, which side total is more? Debit side. Therefore, debit side total 2,50,000 rupees minus credit side total 20,000 rupees. How much is the balance amount? 2,30,000. Which side we should write this? Which side total is less? That side. So credit side we have to write by balance carried down 2,30,000 rupees. What is the date? Last date of the year. Now two sides, write down the total. So first year is completed. Like this, for more 2 years we have to show this asset account. Now come to second year. Previous year there is balance carried down in this missionary account. Means missionary account is not yet closed. Now with that balance we should start this second year. So credit side balance amount we should bring to debit side. Then what should be the date here? Next date of this date. That is 1st April 2010. What we are doing? We have to bring the balance now. So write down balance brought down 2,30,000 rupees. Again, don't write to cash here because in second year we are not purchasing any asset. Okay. Now in second year from 1st April 2010 to 31st March 2011 we use this asset. So second year last date, again we have to provide the depreciation. Depreciation entry is same. Depreciation account at R2 missionary account. So we said it will come credit side. 31st March 11 by depreciation. Annual depreciation is 20,000 rupees now. Take that amount here, 20,000 on the same day by balance carried down. Debit side total is more, 2,30,000 rupees minus 20,000 rupees is equal to 2,10,000. Second year is completed. In third year also do the same. So from here, from credit side, bring the balance to debit. To balance brought down 2,10,000 rupees. Date is next immediate date of this date, that is 1st April 2011. Now in last year also we use this asset for 1 year period. So credit side on 31st March 12 by depreciation. Amount is 20,000 rupees and the balance carried down is 2,10,000 rupees minus 20,000 is equal 1,90,000 rupees. Asset life is 10 years now, but he is asking us to prepare missionary account only for 3 years. So 1, 2, 3 years are completed, but asset account is not yet closed because there is some balance. So for next year, bring the balance and we can leave this problem, because only for 3 years we have to show this account. To balance brought down 1,90,000 rupees. Okay, in this manner we have to prepare asset account under fixed installment method. Now let us see the meaning of fixed installment method. Straight line method is also known as original cost method or fixed installment method or equal installment method. Now, why this method is known as original cost method? Let us see. Observe this example 1. Every year, on which amount we calculated these depreciations? On cost of the asset. Since annual depreciations are calculated on original cost of the asset, this method is known as original cost method. Then why this method is known as fixed installment or equal installment method? Because every year a fixed amount we are charging on missionary in the form of depreciation. Then why this method is known as straight line method? Because if life of the asset and depreciation amounts, if these two are plotted on a graph, then how the depreciation line will be? Let us see. Suppose on x-axis I am taking life of the asset in years, and on y-axis depreciation amounts in 10,000 rupees I am taking. Then first year is 2009 and 10. In first year depreciation amount is 20,000 rupees now. So put a dot here. Then second year also depreciation amount is same. Then second year 20,000. Then third year depreciation is 20,000. Now join all these dots. How the depreciation line is? It is a straight line. It is not a curve. Therefore, this method is known as straight line method. Okay? Now, let us see the advantages of this method. First advantage is, this method is simple to understand and simple to calculate. See the annual depreciation formula? Cost of the asset minus scrap value by estimated life. There are no complicated calculations here. And only in first year, if you calculate the annual depreciation, that is enough. So from second year onwards, same depreciation we can take. We need not to calculate the depreciation again and again. Second advantage is, since this method is simple to understand and calculate, this method is suitable for small firms. Then third advantage is, asset can be completely written off. What is the meaning of this? In example 1, he asked us to prepare asset account for 3 years. Okay? So only for 3 years we prepare this account. But if you work in any organization, then asset life is 10 years, no? So till 10 years you have to prepare the asset account. Then how the last year will be? Let us see. Last year opening date is 1/4/2018. On that day, to balance brought down. How much will be the balance on that day? 70,000 rupees. 10th year last date is 31st March 2019. On that day, depreciation amount is 20,000 rupees, and this is the last day of the 10th year, no? On this day, asset is totally damaged. We cannot use it further. So what we do? We sell it on scrap basis. When we buy the asset, entry is Missionary Account debtor to cash. When we sell the asset, reverse entry, no? Cash account debtor to missionary. Since missionary is in credit side of missionary account, we have to post this entry. So on the same day, by cash, scrap value is 50,000. We sold it for 50,000. So 50,000 rupees. Now two sides totals are same. What is the meaning of this? Asset account is closed. That is known as written off. Okay? Asset value is depleted to its scrap value. So exactly we can close the asset account. See, in first year there is balance carried down in the asset account. Means what? Asset account is not closed in first year. If account shows a balance carried down, then the meaning is that account is still continuing in the firm. In 10th year, since asset is totally damaged, since it is sold in the market, asset account should not show any balance carried down, no? In fixed installment method, we can exactly close the account in this manner. Assume that scrap value is not there in this problem. Then how much is the annual depreciation? 2,50,000 divided by 10. 25,000 rupees, no? Every year, if depreciation amount is 25,000 rupees, then what happens in last year? Last year balance brought down becomes 25,000 rupees. And at the end of last year, depreciation amount is 25,000. There is no scrap value, no? Means we didn't sell that asset in the market. Then two sides totals are 25,000 rupees. See, in this case also there is no balance carried down in the asset account. Means what? Asset account is completely written off. We have second method, diminishing balance method. To calculate depreciation, total 10 methods are there now. Straightline method is the first one. In second method, diminishing balance method, you cannot exactly written off the asset account in this manner. In 10th year also, you will get some balance carried down at the end. That is a drawback of second method. Okay? But in fixed installment method, this is an advantage to us. We can properly close the asset account. Then advantages are completed. Now let us see the disadvantages of straight line method. First disadvantage is estimated life. What is this? See, take patent rights or copyrights, leasehold properties. We can estimate the life of this type of assets accurately. Because suppose patent rights, firm has to purchase the patent rights for a particular period. Say we bought the patent rights for 20 years. Then estimated life of the asset is 20 years. Okay, exactly we can mention the number. Copyrights, we buy for 10 years, 15 years, like that. So fixed installment method is suitable to provide depreciation on this type of assets. But in case of certain assets like machinery, vehicles, lorry, truck, etc., we cannot estimate the life with accuracy. For example, in present problem, we bought one machine in 2009-10 year, no? This is first year, no? And in first year, we are estimating that we can use this asset for 10 years. Estimated life of this machine is 10 years. What is the guarantee that exactly till 10 years only we can use that asset? We may use that asset for more than 10 years period or less than 10 years period. So if estimated life is not an accurate figure, then we cannot use fixed installment method on that type of assets. Then immediately we'll get doubt. In example 1, we provided depreciation on machinery under fixed installment method only. Just now you are telling that on machinery we should not calculate depreciation under fixed installment method. Then why we did problem like this? See, I am not saying that we should not calculate depreciation by using this method on machineries, on vehicles. If you can exactly estimate the life of the asset, then even on machinery, even on vehicles also, we can use this method. Okay? Then, next disadvantage is interest factor. Total 10 methods are there to calculate depreciation. First method is fixed installment method, straight line method. Second one, diminishing balance method. And the third method is called annuity method. In annuity method, firm considers interest factor. What is meant by interest factor? Let us see. 2,50,000 we spent to purchase this machinery. Means this much of capital is invested in this particular asset, machinery. Instead of spending 2,50,000 rupees on machine, if this amount is invested elsewhere, then we get some interest on that, no? Assume that we get 10,000 interest on this amount. But what we did, instead of investing that amount in some outside securities, with that amount, we bought this particular machinery. So, we lost this 10,000 rupees interest. So, under annuity method, the cost of the machine means not only the purchasing price, this interest amount also we should consider. Now, the cost should be taken as 2,60,000 rupees. Means what? Every year while calculating the depreciation amounts, we are calculating the depreciations on two values. On purchasing price we are calculating, even on interest amount also we are calculating. In annuity method, we consider the interest amount in this manner. But in fixed installment method, this interest factor is totally ignored. That is one disadvantage. Then, next disadvantage is, this fixed installment method is accepted by Accounting Standards Board and Companies Act 1956. But Indian Income Tax Act prefers diminishing balance method, not fixed installment method. In fixed installment method, every year we are calculating the depreciation amounts on original cost of the asset. But Income Tax Act prefers to calculate annual depreciations on diminishing balance values. Diminishing values means what? Written down values. Means what? Opening value of the asset. Means if this problem is done according to diminishing balance method, then how depreciation amounts are calculated? First year, opening balance of the asset is 2,50,000 now. On that amount we calculate. Second year, diminished value of the asset is how much? 2,30,000. On that we provide depreciation. Third year, debit side to balance brought down. Some amount will be there now. On that we provide depreciation. Income tax department, they prefer diminishing balance method to provide depreciation, but not fixed installment method. Then, next disadvantage is replacement. What is this? Fourth method of calculating depreciation is sinking fund method. In sinking fund method, what happens? Annual depreciation amounts are 20,000 rupees, no? So in fixed installment method, we are providing 20,000 for depreciation. That's it. But in sinking fund method, every year, the amounts which we are charging towards depreciation, with that amounts, firm creates one fund. Fund means what? Savings amount. That fund is called sinking fund or depreciation fund, and that fund amount will be invested in outside securities. So first year, on last date, depreciation amount 20,000 now. So depreciation fund amount will be 20,000. With that 20,000, firm purchases investments. When? First year, last date. Second year, at the end of second year, again another 20,000 worth depreciation fund will be provided, and with the 20,000 again firm purchases investments. And first year investments are there, no? On that investment, in second year we get some interest amount. That with that interest amount also we buy investments. Means what? Every year, with the depreciation amounts, we create fund. That fund amount we invest in outside securities. On that security, if any interest is coming, even that interest also we use to purchase investments. Till 10 years we do in that manner. So 10th year, at the end, when this asset is totally damaged, what firm does? So every year firm is purchasing investments, no? Now at the end of 10th year, that investments will be sold in the market. Then some amount comes. With that sale proceeds, firm purchases a new asset. Means what? To replace the present asset, firm follows a particular procedure. Okay? In a systematic manner, firm saves some amount to replace the asset when present asset is totally damaged. But under fixed installment method, there is no depreciation fund creation. There is no depreciation investments purchase. Okay? Means what? Every year 20,000 we are charging to asset account. But that 20,000 rupees we are not saving anywhere. Okay? So that amount we may utilize for other purpose, to pay rent, to pay salary, like that. So what happens? Till 10 years happily we use this machine. When 10th year is completed, machine becomes useless and we didn't save any amount to purchase a new asset. Then again we have to go for loans. So unnecessarily you have to pay the interest. Okay? So there is no proper arrangement to replace the present asset. That is a disadvantage in fixed installment method. Next disadvantage is same utility. Utility means what? Benefit. Under Straightline Method, we think that asset gives same utility every year. In case of patent rights, copyrights, this assumption is correct. But if you take certain assets like machinery, vehicle, this assumption is wrong. In present problem, first year is 2009-10. In first year, assume that by using this machinery, we manufactured 50,000 products. So the benefit from this machine is in 1 year, we can manufacture 50,000 units. Then under fixed installment method, we assume that every year we can manufacture 50,000 units only. Therefore, every year depreciation amount is same. So expected life is 10 years now. Means what will be the last year? 2018-19. We assume that till 2018-19, asset gives same benefit to us. But this assumption is wrong. As asset becomes older, what happens to its efficiency? Decreases. Okay? This method is based on another wrong assumption. That is, every year with the same intensity we use the asset. What is the meaning of this? For example, in 2009 and 10, we used this asset for full year. For 12 months we used it. In second year also, we used it for 12 months. But in third year, due to some reason, we used it only for 10 months. In fourth year, we used it for full year. So practically speaking, in third year depreciation amount should be less, no? But once you observe the depreciation amounts in this method, every year depreciation amount is same. Means what? Even though asset is not used for a full year, we neglect this point. We assume that in third year also asset is used for 12 months. So how much depreciation you are providing in first year and second year, same amount of depreciation we provide in third year also. Okay? But this assumption is wrong. Then, next disadvantage is burden on profit and loss account. Means what? Observe. See, in present problem, first year is 2009 and 10. Depreciation amount for first year is 20,000 rupees. If it is leasehold property, patent rights, copyrights, then you need not to spend any amount on repairs. Therefore, you can use fixed installment method for all those assets. But you take machinery, you take vehicles, then as that asset becomes older, you have to spend some amount on repairs. So this is machinery, no? Since this is new, in first year, repair expenditure is nil. Second year, 2010-11, you know this is fixed installment method. So every year depreciation amounts are same. And repair expenditure is nil. Third year, depreciation is 20,000 and slowly we have to spend some amount on repairs. Assume that repair expenditure is 5,000 rupees. Then next year depreciation is same and repair expenditure is 10,000 rupees. Like that, as asset becomes older, repair expenditure increases. Then what is the effect on profit and loss account? Let us observe. Profit and loss account is a nominal account now. Then what is nominal account rule? Debit all expenses and losses, credit all incomes and gains. Say this is first year P&L account. Depreciation is a loss. Losses are to be debited now. So debit side depreciation amount 20,000. We record. And in first year repair expenditure is nil. So towards repair expenditure nothing is recorded. Okay. First year how much we are debited to P&L account? 20,000 rupees. In second year also same now, 20,000 rupees. Come to third year. Third year final account share doing. Then depreciation is debited in P&L account and repair is an expenditure. Expenses are to be debited to P&L account. So repair amount is 5,000 rupees. Total how much amount you are debiting to P&L account? 25,000 rupees. If it is fourth year, how much you are debiting? 30,000. Fifth year, 35,000, 40,000, 50,000. So year by year, burden on P&L account is increasing. You are charging more and more amount to P&L account because every year depreciation amount is same, but repair expenditure is increasing. Clear? Then you may think, okay, then what is the disadvantage in this? The disadvantage here is 1 year profit we cannot compare with other year because every year equal amount you are not charging to P&L account. Okay? So these are the disadvantages of this method. Then finally, I think you have understood on which type of assets we can provide depreciation under Straightline method. First of all, we should able to estimate the life of the asset with accuracy. On that type of assets, we can use this method. What are those assets? Copyrights, patents, leasehold properties, trademarks. Because we purchase them based on some contracts. We purchase them for particular period. Okay? Then second requirement is what? Repair expenditure should be nil or the expenditure on repair should be a negligible amount. In that type of assets only we can use this method. For example, patent rights, copyrights. You need not to spend any amount on repairs. So this method is suitable for that type of assets. With the help of example 1 problem, I explained the meaning, advantages, disadvantages and suitability of Straightline method. Now you should know some more points about this method. So with the help of other problems, I will explain all those new points to you. See the second problem. Ganesh bought a machine for 17,000 rupees. Cost of the asset is 17,000 rupees and paid for its installation 3,000 rupees. 3,000 is paid for installation on 30 September 2011. Depreciation is provided at 10% under Straightline method. Straightline method means fixed installment method. Prepare missionary account up to 31st March 2014. So this is the problem. Here, two new points are there. First one is, once you recollect the previous problem, first problem. In first problem, he has given cost, scrap value, estimated life. So how we calculated annual depreciation? By using one formula, cost minus scrap value divided by estimated life. In present problem, we cannot use this formula because scrap value is not given in the question. In previous problem also, even though scrap value is not there, we can use this formula. If scrap value is not there, you can take 0, no problem. But to use this formula, compulsory we need estimated life. But in this problem, estimated life is not given. Therefore, we cannot use this formula. This is the first new point. And second new point is, installation charges are given. What is meant by installation charges? I will explain in this problem. Okay. See, when they bought that asset on 30 September 2011, what is the entry when asset is purchased? Missionary account debtor to cash account. Our present account is missionary account. In journal entry, missionary is in debit. Therefore, debit side we should post this entry. So, debit side with 2 we have to start now. What to write? Other account name? To cash account. Asset is purchased for 17,000 rupees. Write down that. And while writing the date, remember one point. When we bought that asset at the end of the month, when asset is purchased at the end of the month, then instead of writing the date, we can write next immediate date. So date will be 1st October 2011. Now come to this new point. Installation charges paid 3,000 rupees. First of all, what is mean by installation charges? Listen. Suppose we are running one firm and our factory is located in Dilshun Nagar. We bought the asset from Koti. So from Koti to Dilshun Nagar, we have to bring that asset. For that we have to spend some expenditure. We have to fix that asset in our factory. For that we have to pay some amount. These expenses are known as installation charges or erection charges. Now, what is the journal entry for installation charges? Let us see. Expenditure is divided into two types. Capital expenditure, revenue expenditure. Capital expenditure means what? Rare expenditure. For example, firm purchases building to run the business. Daily we buy the building. Every month we buy the building. No. Only for one time. It is one time investment. So purchasing building, purchasing machinery, furniture, land, vehicle, all these expenses are non-recurring in nature. So they come under capital expenditure. Then revenue expenditure means recurring expenditure. Again and again we spend that amount. For example, payment of salaries, rent, every month we pay. Okay? Now, assume that we paid salaries. Then what is the entry? Salary account debtor to cash account. And we paid installation charges. Then what is the entry? Entry is not installation charges account debtor to cash. Entry is missionary account debtor to cash. Missionary account debtor to cash. Observe the difference between these two entries. In case of revenue expenditure, that expenditure name is debited, salary account is to be debited here. But in case of capital expenditure, we should not debit that expenditure name. We should debit fixed asset name here. Okay? So, entry for installation charges is missionary account debtor to cash account. Means missionary, we bought it for 17,000 rupees. Since 3,000 is spent only for one time, we have to add that 3,000 to missionary value. Now missionary cost is not 17,000, cost is 20,000 rupees. Remember. So remember, if there is any installation charges to cost of the asset, we should add it. And installation charges are also known as erection charges. Now same entry, therefore same posting. On the same day, to cash 3,000 rupees. Some students, what they do, since date is same, since we are writing same names here, they may add both. Only for one time they may write to cash directly 20,000 rupees. Don't show like that. If installation charges are given separately, you have to write that. Okay? Now, when asset is purchased on this date, this is your purchase date. When accounts are closed on 31st March every year, no? Then write down 31st March. Now think about the year. After this date, if March has to come, then what will be the year? 2012. This is the closing date. If this is the closing date, what will be the opening date of the year? 1st April 2011 is the opening date. So, first year is from 1/4/2011 to 31st March 2012. 11/12 is your first year. And in this year, how many months we use that asset? Not for full year. Because when we bought that asset? On 30 September 2011. So September is completed. From October, we started using that asset. So October, November, December. In 2011 year, 3 months we used. Similarly, in 2012, January, February, March. So from 1st October 2011 to 31st March 2012. For 6 months period only we use this asset. Remember this point. Okay? Then for 6 months we have to provide the depreciation. So depreciation always at the end of the year we should provide, no? So first year last date is 31st March 2012. On that day, what is the entry for depreciation? In first problem I told, depreciation account debtor to missionary account. Since missionary is in credit side we have to post this entry by depreciation account. But the difference between first problem and this problem is, in first problem, since in working notes we calculated annual depreciation 20,000 rupees, directly we have taken 20,000 rupees in the account. But in second problem, there is no estimated life, there is no scrap value, we cannot use the formula. So instead of giving that information, he has given rate of depreciation. Every year 10% depreciation we should provide on the asset. Therefore, directly in asset account only we should provide that depreciation. Cost of the asset is not 17,000, 20,000. So remember this point. When installation charges are given, add them to purchase price. and the total amount we should take as cost of the asset into 10%, no? 10 by 100. If you leave like this, then it gives the meaning that for 1 year we are calculating 12 by 12 will be there, but we use that asset only for 6 months. Therefore, what we should do? We should write 6 by 12. Okay? Now, ₹1,000 is the depreciation amount. Then finally balance carried down amount. Debit side total is more, 20,000 rupees minus 1,000 is 19,000 rupees by balance carried down. When? On the same day, 31st March 2012. Then credit side total will be 20,000 rupees. First year is completed. Now come to second year. Second year date will be next immediate date of this date. 1st April 2012 to balance brought down 19,000 rupees. Now second year last date will be 31st March 2013. For depreciation, same entry, so same posting. Credit side by depreciation account. Now, which method we are applying here? Fixed installment method, straight line method. What is the feature of straight line method? Every year depreciation amounts will be the same. But can we take same 1,000 rupees here? No. Even though it is fixed installment method, don't take same 1,000 rupees here. The reason is, in first year, we use that asset only for 6 months. But in second year, from 1st April 2012 to 31st March 2013, we have that asset with us. For full year, we used it. Therefore, we have to calculate the depreciation again. And this is original cost method, no? So every year on cost of the asset only we should provide the depreciation. So second year also on cost we should calculate the depreciation. So second year depreciation is 2,000 rupees. Then balance carried down amount is 19,000 rupees minus 2,000 is equal 17,000 rupees. Balance carried down. Now up to which date he is asking? 31st March 2014. Okay. Then bring that amount to next year. 1st April 2013 to balance brought down 17,000 rupees, and on 31st March 2014 by depreciation. Now we need not to calculate the depreciation again, because in second year we use the asset for 1 year period, no? And already we have calculated the depreciation here. So in third year also, since we use that asset for same period, 1 year, we can take same 2,000 rupees here. You need not to show the calculation again. Okay? Now, 17,000 rupees minus 2,000 is equal to 15,000 rupees. Is balance carried down. Okay. Now for 3 years he asked, for 3 years we prepared the account. Since asset account is not yet closed, in third year there is some balance carried down. For fourth year, bring the balance and leave the problem. To balance brought down 15,000 rupees. Okay. Now see the third problem. Kiran and Sons purchased a machine for 42,000 rupees and paid 8,000 for its erection. Erection charges means installation charges on 1st April 2009. Additions are made to the machine on 1st April 2010 for 20,000 rupees. This is a new point in this problem. Accounts are closed at the end of financial year. Depreciation is allowed at 10% per annum under fixed installment method. Under straight line method only we should calculate the depreciation. Prepare missionary account for 3 years. This is the question. Okay. So what is the new point in this problem? Additional asset we bought. There are 2 machines. So don't think that 2 missionary accounts we have to prepare separately. In same account, these 2 assets information we should show. Okay. On 1st April 2009, they bought one missionary. So debit side 1/4/2009 to cash 42,000 rupees. And they paid 8,000 rupees installation charges. You know the entry, missionary account at R2 cash account. So debit side to cash 8,000 rupees. First missionary cost is 50,000 rupees. Now first year last date is what? They are following financial year now. Then date will be 31st March 2010. On that day by depreciation. Since estimated life is not given, what we should do? We cannot use the formula. The rate of depreciation is given in the question. So in asset account only we should calculate the depreciation. Now cost of the asset is 50,000. Rate of depreciation is 10%. And when we bought this asset on 1st April 2009. So from that day to 31st March 2010, full year we used it. So no need to write any months. For a full year we are calculating the depreciation. Depreciation on first asset is 5,000 rupees. Then on the same day by balance carried down. 50,000 rupees minus 5,000 is equal 45,000 rupees. First year is completed. Then come to second year. Bring the balance to balance brought down 45,000 rupees. Now in second year on starting date we bought another machine. So entry will be missionary account debtor to cash. Since missionary is in debit side we have to post this entry to cash account on the same day. Then second asset cost is 20,000 rupees. Now come to last date of second year. On this day, by depreciation. On this date, we have two assets, no? So two assets are used for full year. Therefore, in inner column, separately you have to calculate the depreciation on two assets and total depreciation show in outer column. So on first asset cost is 50,000. On 50,000 for full year, already we have calculated the depreciation here. Same depreciation we can show. We need not to calculate it again. 5,000. Then second asset. Second asset is purchased in current year, no. So depreciation is not yet calculated. So now we have to calculate. Second asset cost is 20,000. On that, same percentage of depreciation we should take. 10 by 100. And when it is purchased? On the starting date of the year. Therefore, we have to calculate the depreciation for full year. 2,000 rupees. Then total depreciation in outer column is 7,000 rupees. So 7,000 rupee depreciation includes two amounts. On first asset, 5,000 is the depreciation value and second asset depreciation is 2,000 rupees. Okay? Then put this in brackets. Now debit side total is 65,000 rupees minus credit side total 7,000. So balance carried down will become 58,000 rupees by balance carried down on the same date. Now take the balance to third year. 1, 4, 11. To balance brought down 58,000 rupees. Then for 3 years he is asking now. This is the third year. Third year last date is 31st March 12 by depreciation. On this date, how many assets we have? Two assets. Two assets are used for full year. So on first asset depreciation is 5,000 rupees. On second asset 2,000 rupees. Already we have calculated them. So again you need not to calculate here. If you want to show in inner column. On first asset depreciation amount is 5,000. Second asset 2,000 rupees. Then total depreciation in outer column is 7,000 rupees. Now remaining amount is balance carried down. 58,000 rupees minus 7,000 rupee is equal 51,000 rupees. For 3 years we prepared the asset account. Now since asset account is not yet closed, bring the balance to next year and leave the problem. To balance brought down 51,000 rupees. So what is the new point in this problem? There are two assets. When two assets are there, in inner column we have to calculate the depreciation on both and total depreciation in outer column we have to take. Clear? Now next problem, fourth problem. Raghava bought a machine on 1/4/2009 for 70,000 rupees. Depreciation is charged at 10% under Straightline Method, original cost method. On 30 September 2011, he found that the machine was not suitable and sold for 60,000 rupees. Firm sold that asset for 60,000 rupees. Show the missionary account. This is the question. Now, what is the new point in this problem? After using for some years, firm sold that asset. When asset is sold, how to prepare the asset account? That point we are going to learn now. When they bought that asset on 1st April 2009. So debit side on this date to cash account. They purchased that asset for 70,000 rupees. Now financial year they are following, no? So what is the last date of first year? 31st March 2010 by depreciation. Estimated life is not given and rate of depreciation is given. So calculate the depreciation in the account only. On 70,000, 10%. And when they bought on 1st April 2009, since they used the asset for full year, we need not to take the months here. Annual depreciation is 7,000 rupees. Then on the same day, by balance carried down. 70,000 minus 7,000. 63,000 rupees. First year is completed. So bring the balance to second year. 1st April 2010. To balance brought down 63,000 rupees. Okay. And what is the last date of second year? 31st March 2011. On that day, again we have to provide depreciation. Since this is fixed installment method, every year depreciation amounts will remain same, no? So second year we need not to calculate the depreciation. Previous year amount we can take. Then on that day, balance carried down is 63,000 rupees minus 7,000, 56,000 rupees. Now, bring the balance to next year. Now, in third year, there is a new point. What is that? On 30 September 2011, they sold that asset for 60,000 rupees. Okay. What is the last date of third year? Let us see. If starting date is 1st April 2011, then last date will be 31st March 2012. On 30 September 2011, we sold that asset. Okay. So in third year, from when to when we use that asset? From 1st April 2011 to 30/9/2011. For how many months we used? April, May, June, July, August, September. Only for 6 months we used. Therefore, we cannot take same 7,000 rupees here. And what should be the depreciation date here? Always you remember, when asset is sold, up to that date only we should calculate the depreciation. In previous years, what happened? Since we didn't sell the asset, at the year end, we calculated depreciation. But in third year, we should not calculate the depreciation on 31st March 2012 because on that day, there is no asset. So asset is with us up to 30 September 2011, no. So depreciation also we should calculate on 30 September only. Be clear with this point. 30 September 2011, by depreciation. Since only for 6 months we used, we cannot take 7,000 as it is. We need a separate calculation here. And under which method we have to provide the depreciation? Straight line method, no? What is the feature of straight line method? Every year on original cost only we should provide the depreciation. So in third year also we have to calculate the depreciation on 70,000 rupees. Depreciation percentage is 10, and for how many months we should provide the depreciation? 6 months. Therefore, into 6 by 12. $3,500. So depreciation for 6 months is 3,500 rupees. Now, on that day, they sold that machine for 60,000 rupees. When they buy the asset, what is the entry? Missionary account debtor to cash account. Since missionary is in debit side we are writing. Now, what happened on this date? They sold the asset. So, reverse entry will come now. Entry for sale is cash account debtor to missionary account. Since missionary is in credit side you have to post this entry. When we sold? On 30 September 2011. So write down that date. Don't write last date of the year. On that day, by cash. Suppose we sold that asset and we got a check. Then we can write bank also. Okay? For how much value we sold this asset? 60,000 rupees. Always you remember, sale price will be given in the question only. Okay? Now, what to do? When we sell that asset, in that sale process, we may earn some profit or we may incur some loss. That profit or loss in that sale of asset, we should ascertain now. So put the heading, calculation of profit or loss in sale. Procedure is, first you have to take cost. Cost is 70,000 rupees. If installation charges are given, for example, installation charges 5,000 rupees, then here 75,000 we have to take. Then minus total depreciation, not annual depreciation, total depreciation we have to deduct. Okay? Now, first year is 2009-10. For 2009 and 10, depreciation amount is 7,000. Write down in inner column. Second year 2010 to 11. For 2010-11, depreciation amount is 7,000. Third year 2011-12. Third year depreciation amount is 3,500 rupees. Now total you have to write in outer column. 14 plus 3, 17,500. Now 17,500 is what? Total depreciation. So from cost, total depreciation we have to deduct. Then the remaining amount is 52,500 rupees. This 52,500 rupee is known as book value or written down value. So book value means what? Cost minus total depreciation is equal book value. Now that amount and sale amount, both we have to compare. We should not compare cost with the sale amount. You may think, so in sale we have to calculate the profit or loss. What is there in that? We purchased asset for 70,000 and we sold it for 60,000. So there is a loss of 10,000. This is not the correct way. Because when asset value is 70,000 on 1st April 2009, are you selling on that day? No. We use that asset for 2.5 years. After 2.5 years also, asset value will not remain same. That is why don't compare cost price with sale price. So which two amounts you should compare? Book value and sale price always you have to compare. Okay. Now 52,500 worth machine, we sold it for 60,000. We sold for more value. So there is a profit in sale. Then how that profit comes? Take sale value 60,000 minus book value or written down value 52,500 rupees. Then the difference is 7,500 is what? Profit, no? Then that profit we should transfer to profit and loss account. Okay? Now profit and loss account is a nominal account, no? What is nominal account rule? Debit all expenses and losses, credit all incomes and gains. This is profit, gain. So which side it should be? It should be in credit side, no? 7,500 means what? If you want to post 7,500 in credit side of P&L account, in journal entry also, beside profit and loss account should be there in credit side. Amount is 7,500. Then debit side what to write? Missionary account. Why? Because missionary is an asset. Asset comes under real account. Real account principle is debit what comes in, credit what goes out. We sold one asset and we got some profit in that. Then what happens? That profit will be added to missionary value, no? So it gives the meaning that missionary is coming into the firm. Therefore, debit side we should write missionary account. So what is the entry for profit? Missionary account debtor to profit and loss account. Now we are preparing missionary account. In journal entry, missionary is debited, no. Therefore, debit side we have to post. What to write? Other side, account name, profit and loss account. And what should be the date? When we sold that asset? On 30 September 11. When we sell that asset, on that day only we get profit or loss. So, sale date only we should write here. 39/11. Okay? Now, profit amount is 7,500 rupees. Then, debit side total is 63,500 and credit side also we should get the same amount. Then only your problem is correct. Why like this? Because in third year asset is sold. So asset account should not show any balance carried up. Assume that these two amounts are not same. Some difference is coming. What is the meaning of that? Still there is some asset which is not correct. Okay? Assume that in sale we incur some loss. Then what will be the entry for loss? Reverse entry, no? Profit and loss account debtor to missionary account. Since missionary is in credit, Credit side we have to post this entry. For loss also what to write here? By profit and loss account. So remember, if asset is sold, then what is the new point? We should calculate the profit or loss on that sale separately, and if we get profit, we should take that in debit side of this account, and loss is to be credited to this account. Okay, so under fixed installment method, these are the important points. Now in next video, I am going to explain about second method of providing depreciation, that is diminishing balance method. Thank you.